Hello traders, welcome back to another exciting topic. In our previous video, we laid the groundwork by explaining the fundamental concepts of supply and demand. Now, it's time to take it up a notch and explore the factors that drive these market forces. You might be wondering how these factors come into play in the forex market. Well, fear not, I've got you covered. Because in this video, I will explain the factors that influence supply and demand in the world of forex trading. Let's dive right in. Now, when it comes to supply and demand, these market forces can be influenced by various factors. Today, we're going to explore three key elements that play a crucial role in shaping supply and demand in the forex market. These factors are economic indicators, market sentiment, and central bank policies. So let's break down each of these factors. We all know that the forex market is a global marketplace. People from all over the world are participating in the forex market. Because of that, macroeconomic events play a greater role in forex than ever before, influencing the supply and demand of the market. Here are some of the economic factors you need to look out for in the forex market. First is inflation rate. Rising inflation weakens a currency's purchasing power, which has a direct impact on supply and demand in the forex market. When inflation rises, the cost of goods and services increases, leading to reduced consumer spending and investment. As a result, demand of the currency decreases as investors and consumers look for alternatives to preserve their purchasing power. Second is gross domestic product or GDP. Robust GDP growth indicates a strong and healthy economy. Higher GDP growth often leads to increased investor confidence as it signals a thriving business environment. Third is the unemployment rates. High unemployment rates indicate economic instability and uncertainty. In such situations, consumer spending tends to decrease as people become cautious about their financial prospects. This tempered consumer spending lowers the demand for goods and services, including the country's currency. Last but not least, is a positive trade balance. A positive trade balance where export exceeds imports indicates economic strength and global competitiveness. This success in international trade increases demand for the country's currency, driving its value higher and vice versa. Okay, hopefully you can understand clearly about this topic. Let's move on the next topic. Another factor that influences supply and demand is market sentiment. Market sentiment refers to the overall feeling of mood of traders and investors towards a particular currency or the forex market as a whole. Positive market sentiment indicates optimism and confidence, leading to increased demand for a currency. The negative market sentiment reflects fear of uncertainty, resulting in decreased demand for a currency. Market sentiment can be influenced by various factors such as economic data, geopolitical events, news headlines, central bank announcements, technical analysis, and social media. Positive economic data, favorable geopolitical developments, and optimistic news can generate a positive sentiment, leading to increased demand for certain currencies and vice versa. Sudden shifts in market sentiment can lead to significant price movement and create trading opportunities. When sentiment changes abruptly, it often reflects a collective change in perception among traders and investors regarding the future direction of a currency pair or the overall market. For example, positive news or a surprising economic indicator release can quickly shift sentiment from cautious to optimistic. As traders react to the new information, they may rush to buy a particular currency, driving its value higher. This surge in demand can lead to rapid price appreciation, resulting in bullish market sentiment. Alright, I think that's enough about the market sentiment. Let's move forward to the next factor. Central banks are financial institutions that oversee a country's monetary system, including the circulation of currency and interest rates. This is why it's impossible to talk about forex without talking about central bank policies. So, how do the central banks affect currency prices? One of the primary ways central banks impact currency price is through their decisions on interest rates. When a central bank raises interest rates, it signals an increased demand for money and indicates that the bank will supply less of its currency. This leads to a higher value of the currency in the forex market. On the other hand, when the central bank lowers interest rates, it indicates a lower demand for money and a willingness to supply more of its currency. As a result, the currency value in the forex market tends to decrease. Central banks' action and communication with the market can lead to volatility and create trading opportunities. As a result, traders need to be vigilant and react swiftly to central bank news to maximize potential profits and manage risk effectively. Additionally, central banks may use the other policy tools, such as quantitative easing or open market operations, to influence currency price indirectly. This will impact the money supply and can have secondary effects on currency value in the forex market. So, this is why you should pay close attention to central bank announcements, especially those regarding interest rate decisions, as they can have a significant impact on currency prices. These announcements provide valuable insights into the bank's stance on its economy, inflation, and overall monetary policy. You must adjust your trading strategies based on central bank action and statement. For example, if a central bank hints at raising interest rate in the future, traders may anticipate a strengthening of the currency and adjust their position accordingly. Alright, that's how central bank policy can affect the supply and demand in forex trading. So, next time you trade, it's better to check the recent central bank policies. Awesome! Now you have understood the factors that influence supply and demand in forex trading. Being aware of them can help you make informed and successful trading decisions. See you in the next video and happy trading!